Corporate finance practice problem using OneNote. Internal rate of return, the IRR, the problem 1. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side. We're in the practice problems, and then down in the 1221 internal rate of return, the IRR or problem 1. Also note, when using OneNote, you take a look at the immersive reader. Many of our practice problems up top will be in the text areas down below. Also, same name, same number. They'll have transcripts that can be translated into multiple different languages and either listened to or read in them. Closing out the icon, we're going to have our information up top. We'll do our calculation down below. We're going to be using the internal rate of return, the IRR or No one really calls it the by the way, but I think it could be a helpful way to remember it. In any case, this is another kind of method that could help us with a long-term type of project, similar scenario that we have seen in the past with the payback period and the net present value, where you have an initial investment up front and then you expect to be paid back in the future. That might be for an investment, that might be for a project, that might be equipment that you'll be purchasing, that might be inventory that you're purchasing. The idea being initial investment upfront, time period 0 oftentimes, and then thinking about the number of payments that you're going to receive into the future. When you're looking at the internal rate of return, it can be one of the more complex ones to kind of think in theory. It was for me to basically understand in theory, and also a more confusing one for the test questions to force you to calculate, because it's a complex formula to basically do on paper and pencil. But now that with Excel and financial calculators and whatnot, it's much more easy to do in an Excel type of worksheet. So in practice, very useful. In theory, it's one of the ones that you really want to be using because it takes into consideration the time value of money as opposed to the payback period. So look for questions like that if you're working on a test question. Which one would be better when you're evaluating projects or comparing them? Payback period or the internal rate of return? Typically, the internal rate of return is going to be the calculation that you're going to want because it takes into consideration the time value of money. You could think about it as being related to the net present value that we saw in a prior presentation. So we'll kind of do the net present value here again and think about the net present value and the relationship to the internal rate of return. So remember, the net present value, when we think about the net present value, we usually have a hurdle rate that we have, or a required rate of return, or a cost of capital type of rate. And that rate has built into it not only just like the interest of money, but our expected return on the money. If we calculate our net present value with that number and come up to anything above 0, we will have gotten a return based on that internal rate of return and possibly then accept the project. What we don't know, however, is if we come to some number other than 0, we don't know what the actual rate of return is. And that's basically what the internal rate of return will calculate. So let's see this intuitively here. We'll do this basically calculating the net present value and then think about what the rate needs to be to make the end result 0, which would be the rate that makes the net present value 0. And that's how you can kind of think about it. What is the internal rate of return? That's the rate of return that would make the net present value of the series of payments 0. And then we'll think about a calculation within Excel that we can do after this and look at the formula within Excel to populate this information as well, going straight to that calculation, which is useful, but also it's not as intuitive. So it really is useful to first do the net present value. So what we're going to do is use a goal seek kind of concept. So we're going to basically do the net present value, assuming a certain rate. Oftentimes in practice, we will already have a rate, the hurdle rate, the required rate of return. But if we don't have that, we can assume a rate, calculate the net present value based on it, and then think about what that rate needs to be in order to make the net present value 0. We can use something called goal seek to find that calculation in Excel. So let's first pick a rate, 10%. Our series of payments will look like this. We're going to put down $100,000. Then we're going to get back, we're assuming $14,000 a year for 11 years. Now, this happens to be the same amount of payments for the 11 years in this case, But we could think about situations and will in the future where we have uneven payments or even negative numbers and whatnot in the future, like outflows that happen in the future. So for now, we'll keep this. If we write down our series of payments, we're going to say that the first one is an outflow of the 100,000. And then if we just write down the same kind of series of payments here, we're going to have how many periods? We had 11 periods of 14,000 that we're going to receive. 100,000 outflow minus all the 14 inflows means that if we do not take into consideration time value of money, we've got a net 54,000 basically gain after the full time period, after the 11 years, in other words. But if we take into consideration the time value of money and present value this using the 10% rate, and I won't do the calculations here. I'm going to assume we kind of do this in Excel, but you do the present value of the 100,000 at time 0. As we saw in a prior presentation, obviously that would be 100,000 because we are at time 0. That's the initial investment. 1 year out, we expect to get 14,000. If I present value that one item, we get to the 12,727. Also note that if it was a book problem, you might be saying, hey, look, that 14,000 in 11 years looks like an annuity. You might be thinking, hey, I can do this a little bit easier with an annuity calculation. You may be able to, but oftentimes when you use Excel, it's easy to just do the present value of 1 for each one. And if the payments were not even, then you could still do it this way because you could just do the whole thing as the present value of 1 type of calculation. So that's how we'll think about it here. The next 14,000, if we bring it back, is going to be the 11,570. The next 14,000 3 years out, if we bring it back, would be the 10,518. The next 14,000 4 years out would be the 9,562 if we present value using the 10% discount rate, and so on. All the way down, you can see that the even amount of payments are worth a consistently less amount because of the time value of money. We come to a negative 9,069. What does that mean? That means that at the 10% discount rate, we're not getting the 10%. We're not getting the 10% if it's anything other than 0. If it's below 0, we're not getting the 10%. If it's 0 exactly, we're getting the 10%. If it's above 0, then we're getting something more than the 10%. So we're getting something less than 10%. So now the next question might be, well, what are we actually getting then? What's the actual return that we're getting? We know it's lower than 10%. One way we could do that is we could do trial and error and say, hey, let me just adjust this percent here until we get to something that makes this number 0. So that would be tedious to do by hand, but with Excel, quite easy to do. So we can use goal seek, and we do this in Excel, so you can take a look at the Excel if you want to look at the process that way. To change this, we're going to say change that to whatever it needs to be to make all these present value calculations come out such that this end result equals 0. If that is the case, then that's going to be the rate that will make this 0. That's the internal rate of return. So if you let Excel basically do that, if we were to recalculate this entire thing with the 7.99 about, it's rounded to 7.99, present value this whole thing with the 7.99, that then takes us to 0. That's the internal rate of return. This is the percent that makes this series of payments, these estimated future payments, 0 based on this discount rate, which could be called the hurdle rate. It could be called the required rate of return. And then once we have this rate, we can then compare that if we have some set rate, like a rate of return that we want. If 10% was our required rate of return, we can compare this to that required rate of return. If it was lower, then we probably wouldn't accept it. If it's higher, then we would think about accepting this. So in practice, how would you use this type of calculation? Usually we're going to think about the rate of return we want in order to take on a job. And you saw in a prior presentation, we calculated the net present value based on that rate. We can also think about just simply calculating the internal rate of return and seeing if it's higher than that rate that we would have to accept a job. We can also, or a project or whatever investment we're putting into. We can also match up different projects and match up which one would be better. The higher the internal rate of return, the better the odds of the project would be. So we can then line up different projects and just look at which has the higher internal rate of return. Now we could do the same thing with a rate in Excel. So if we were a formula in Excel, it's difficult to do by math. So if you're doing this on a test question and writing out, they will quite often ask you questions about the internal rate of return and emphasize the fact that it does take into consideration the time value of money, relate it to the net present value calculation, but they don't often make you calculate it if you don't have access to some form of calculation like a financial calculator or Excel. So you want to understand it conceptually. If you have Excel, you can calculate it the way we did with GoalSeek, or we can then do this actual formula, which magically comes up to the result, which I would then verify by putting it into the net present value calculation. So to do that, you first need to put your numbers into the proper series again. So this is what you want to practice, building a table like this, which means it's going from period 0 to 11. Make sure you add period 0 to period 11. Then we add our series of payments, outflows being negative, inflows being positive, outflows negative, inflows positive. There's our $54,000. That's basically the net income, not including the present value calculation. And then we just enter the equals IRR and then brackets, and it's basically a sum function, just like the sum function, or similar to the sum function. We have a range of cells, which would include the 100,000 down to the last 14,000, not including the total down here, down to the last 14,000. And that would magically give us the 7.99, the internal rate of return, which we can compare to other projects or the required rate of return to see which would be better. The higher, the better for the internal rate of return. Once you had this, if you did this calculation, you might want to double check it, verify it, by simply then plugging your number in, working your net present value calculation using the internal rate of return that we just got, and you should get to a bottom line number of 0 if everything was done properly there. So it's good to go back and forth between the net present value and the internal rate of return to understand how they complement each other, understand the relationship between them for better decision-making processes, and so that you can answer basically test type questions related to the relationship.